My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Tech was back today, just like the old days. These things were rallying like it's 2020, which is how you end up with a session where the Dow dips 113 points, the S&P ticks down 0.08%, but the Nasdaq jumps 0.63%. At one point, it was much higher before everything folded at the end of the session. Suddenly, the whole group felt so tempting, didn't it? Oh, there's just one problem with tech: the fundamentals. You see, they're much worse than Wall Street seems to believe. A key reason why the huge gains didn't last and shouldn't be expected to. See, today we got a clear counter-trend rally in the morning, albeit one that fizzled late in the day, based on a cessation of tech selling by big institutions and last Friday's weaker-than-expected wage inflation number, which suggests the Fed might not have to tighten as aggressively as we thought. This kind of rally, it's seductive. It looks like the real thing. It lasts a little longer than you might expect because there's nothing in the way. Earnings season kicks off this week, but we don't hear from any tech companies. Not for a week or two do you really get that. But you see, the move is, as we saw at the beginning of the day, the move was wrong. It was wrong. What are people doing? They're selling healthcare. They're selling the oils, the industrials, the aerospace, all the groups that are cheap versus their long-term prospects. And they were clobbered. And by the end of the day, I think many of them actually represented some great opportunities. Meanwhile, the tech companies with stocks that roared earlier today, well, when they report, it's most likely that they will tell analysts that their forecasts are too high. Yes, number cuts when they report. So let's do this. Because it was such a complicated day, let's break down the whole session so you really understand, okay? Because today's tech-led rally may have been tradable, but it wasn't something that we find is much more important on Mad Money. It wasn't investable. See, at the end of the day, we want to be investors. It's a better strategy over the long haul, especially because you can't really be a good trader unless you're doing it as a full-time job. But you can absolutely be a good part-time investor, and that's who we're trying to teach here. What do I mean when I say the tech rally is not investable? Look, this move started on Friday after we got a set of cooler than expected economic numbers, wage inflation, factory orders, and the service sector were all softer than we thought. In response, bond yields tumbled, and when that happens, the whole stock market tends to roar. Until Friday, many stocks have been headed lower, and the worst performers were indeed tech, led by FAANG. Yes, those multi-billion-dollar mega tech companies, and also the enterprise software companies. So you could say that those were certainly due for rebound, simply because they'd already been hit so hard. That's why tech seems to snap back the hardest every time we see soft economic data, and that leads us to believe that the Fed will be willing to stop bringing us the pain, even as nobody at the Fed's saying that. Now, look, I don't blame anyone for trying to trade these moves. It's what we used to do back in my old hedge fund, but I was doing it full time. If strong economic data means more Fed action and more tech selling, like in November of 2021, then naturally weak data is a green light to buy tech, and at least short term. But again, you can't game this kind of thing unless you're running money as a full-time job, and even then, it's mighty hard. For everyone else, we buy stocks because we're betting on the underlying companies. We want to own the companies that are doing better than Wall Street expects and avoid the ones that are doing worse. These short-term sector rotations like we saw today, they're irrelevant because they can't last. Think renters, not owners. The fundamentals, now they last. So let's take a look at the action in two key groups so you understand what's really going on here. There's tech, which soared today, and healthcare, which got no love whatsoever. Holy cow. Many of the big hedge funds are what's known as catalyst-driven. We heard lots of good things about healthcare ahead of this big J.P. Morgan healthcare conference that started this week in San Francisco. We even had Lisa Gill, J.P. Morgan's top analyst at the conference, on the show last week. She gave us some great insight about what to look for. All the best stories, well, let's just say they were bid up in advance. So today the conference started, and it turned into a sell the news catalyst situation. There wasn't enough new money coming into the market to say something like J&J. Yes, Johnson & Johnson, fantastic long-term story, that got clobbered when its CEO predicted aggressive numbers. They were greeted with skepticism by many. It turned into a rout where almost everything healthcare got crushed. I like that. I like it if I went on those stocks. At the same time, the tech stocks kept their rally going as the big sellers finally seemed to take a break. Perhaps because they were actually buyers coming into the market for once? I don't know. That tech rally ran out of steam when a couple of Fed officials reiterated that they've got no plans to take their feet off the brakes. Still, this one was seductive. That's the word I keep coming back to. Seductive enough to pull people in, even if it might turn out to be extremely short-lived. You might have been pulled in. You might have found it seductive. So how can tech rally like this, even though we all know the fundamentals are awful? Well, because it's very easy for stocks to come untethered from their underlying business in the short term if the companies are getting serious about the bottom line, because it changes their complexion. So I want you to take a look at, let's talk about Cramer fave, long-term Cramer fave, Salesforce. It was up nearly 5% today. Last week, these guys announced they're going to lay off 10% of the workforce. Then on Friday, we learned that 10% may not be enough. Salesforce has made a series of very expensive acquisitions, notably Tableau and Slack. The integration hasn't been as rigorous as it could have been, but Salesforce is still one of the best-run cloud software players. So if they need to let go more than 10% of their employees to get things really going and humming, well, then you have to think to yourself, what does that mean for the rest of the industry? Tech's had so many good years that these companies have almost no spending discipline, meaning that there's still a lot of fat for them to cut as the economy cools off. Wall Street loves these layoffs right now. And if Salesforce can do this, then maybe Microsoft or Alphabet or Amazon can. I know Amazon's already said they're going to let go 18,000 people, but that's nowhere near what they need to do. Alphabet and Microsoft may actually need to make cuts if the economies around the world don't improve, and it looks like they aren't. Now, you see, from the market's perspective, it's good that these companies are starting to get religion on cost cuts. Long term, though, obviously, it's not good that tech's struggling, and the whole industry desperately needs to fire tons of people. We want strong revenue growth, not weaker revenue growth and cost cutting. But these days with tech, I guess we'll take either. Now, there are other signs that things are less than swell in the markets, too. Lululemon, a fantastic growth company, announced a shade down for earnings, just teeny-weeny, and its stock got crushed, down $30 or almost 10%. On Friday afternoon, Macy's said it had a less-than-ideal holiday season. And I see it, other than discounters, you won't believe there won't be a lot of money to be made in the retail stock. So what happened? Macy's stock dropped $1.70 or 7.6%. What makes this more difficult is that we don't have new money coming into the market. In fact, we have the opposite. People are continuing to pull out the money in droves. Yeah, they want to be in CDs. They want to be in very, very nice, high-yielding treasuries. So if hedge funds want to buy tech, they need to sell something else to fund those purchases. And today, they sold healthcare and retail. These short-term rallies are they're all based on ephemeral themes, not how the underlying companies are actually doing. So they have rarely been able to have staying power. For the Charitable Trust, we used today's rally to do the opposite. We made tech sales because business is deteriorating, and the Fed's not coming to the rescue anytime soon for the tech stocks. At the end of the day, I expect most tech companies to miss the estimates. And that almost always leads to lower stock prices. It isn't easy to be disciplined. It isn't easy to ignore stocks that rally 10, 11, 12 points, as many stocks were doing earlier this morning and suck people in. Seductive. If you bought that, you were betting that there's another 10 or 11 or 12 points down in your future. Well, you ended up losing money today if you did that. But the bottom line, just remember, if you were buying tech here off some weaker macroeconomic numbers, you're not investing. You're simply gambling. And if you're going to gamble, you know what? You might as well go blackjack. Yeah, go play blackjack at the casino. The odds are better. Tony in Pennsylvania. Tony.
Hey, Jim. This is a healthy new year to you, Big Jim.
Thank you, Tony. Thank you.
How you doing, buddy? You hanging in there?
I'm doing good. Yeah, I'm hanging in like everybody else. What's happening?
My stock is Shake Shack, Jim. Long-term hold, or should I shake it out of my portfolio? What do you think, Jim?
I think that one of the things that we have to do at times is say, do we like the product? And is the balance sheet okay? And can they do well? And this is one of those situations where the company's not making as much money. I think it can make more money, but the product is good. We all like the product. I think it's a hold. I don't think it's a buy, and I think you'd hold it. And thank you, Tony, for those fine comments. Let's go to Trey in Texas, please. Trey.
Jim, everyone's looking for the next FANG stock except me. I'm personally looking for the next Chipotle, and Jim, I think I found it in Sweet Green. What do you say?
No, look, first of all, I think you're absolutely right to go looking for Subway from Fan, but I have a problem with Sweet Green. They really surprised us to the downside. I was a little let down by them. I did not think they did that good a job. I can't necessarily tell you to go buy Chipotle, but I think Chipotle is the better buy. Let's go to Matthew in Georgia. Matthew.
Hi, Jim. How you doing?
I'm doing well, Matthew. How about you?
Very good, very good. Question I had for today, what I wanted to ask you was, I have Home Depot stock for the last over 20 years. I used to work for them, but yeah, it was a long time ago. So I have about 200 shares, and I'm trying to figure out if I should diversify. I had more than that, but I had sold some off. But
I'll tell you, Matthew, you were in good hands with Home Depot. Now, it doesn't necessarily mean that this. I'm trying to teach people something. In 2023, I'm really trying to emphasize this. I don't know how this quarter is with Home Depot. I know it's a great franchise we like to shop at with good balance sheet and excellent management. And that says to me, own Home Depot, not for the quarter, but for the duration. All right, now, look, I know it isn't easy to be disciplined. I'm trying to teach it. Please remember, if you're buying tech here off some weaker macroeconomic numbers, you're not investing. You're most likely gambling. On Mad Money tonight, ConAgra shot the lights out last week when reported earnings. So can the strength of the packaged food sector continue into 2023? I'm asking the CEO. Then what should you do if you miss the 5 best trading days of the year? I'm going to give you my advice. And it's been almost 1 year since the Constellation Exelon breakup. I've got Exelon's brand new CEO to find out how the company is working to transition to a cleaner future. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.